Good day, all. Ira Epstein, and here we are with your financial market wrap-up. And this wrap-up is for Monday, the 27th of February, 2023, about 6:40 p.m. Central Time. So we're sitting here coming to the end of the month, and the market's asking itself, what about these interest rates? How aggressive is the Fed going to get? We started off this morning a powerhouse. We were up 300 points, I think, in the Dow at one point. We gave that all up 1, 2, 3. And the market did close higher. You'll see that on the charts, but nowhere near that verve that it had early on. I think part of that was playing that the market had a terrible week and traders came in and they were buying things up. But where are you going if you keep adding to the interest rate? Whoa. You know, why would you buy securities if you can get 5% return on short-term instruments? And I'm reading some of the ETFs that are out there. You can go into them, and then some of the short bond ones, they're paying 5% yields. I was sending it to my friends. One of my friends was calling me, saying, Ira, how do I go about getting that yield? So I send him this. It's a simple way. You do it right in your account. And it can't be any easier than that. And you don't have to be one of Goldman or somebody's big clients to go out and get that type of return. Those are things you got to consider. And that's what weighs on the stock market. Stock market's normally a great thing to own, especially low interest rates, which maybe we got too low, strong economy. That's not what the Fed wants here. The Fed wants here to put a headwind in front of the economy and slow the inflation cycle down. So remember that. I want to remind you before we go too far, and we'll get into all this, we're going to have our live question and answer, our webinar. That's going to be this Thursday. It's at 12:30 p.m. Central Time. You are invited. If you didn't get an invite from me in your email box, it means that it's not going to come to you. Just come here and move your cursor to the very top. You'll see an icon appear. When you see that icon, just give it a click. That'll open up the invite. Just fill out the form. It will return to you your user ID and your password for this. That's how you get in. And do me a favor, if you have SPDR or ETF questions, there's an area there to write me the questions you want me to answer, and I will go about it. I'm not going to ask the questions. I'm going to answer them. And that helps me to prepare the charts. It's only 20 minutes long. It's very fast paced. You don't want me typing in things and putting the indicators on the chart and searching for it that way. I can get a lot more done. The futures I have done, and I can answer your technical questions, 1, 2, 3 on those. You can call my staff if you have a problem, 866-973-2077, and that icon will work this whole time. So let's take a look, if we could today, and get to these charts. I'm going to keep the S&P up for a couple of days. I was going to take it off, and I started looking around, and I go, we're at such a darn important point on the weekly charts. We're back to the 18-week average. You're hearing traders, and I'm hearing it on all the news stations, hey, we're trying to recapture and hold the 200-day average and all that. You're at an important point in this market. You're at an inflection point. And you can see how the market is let go to the downside. The pattern is one of lower highs and lower lows. Now, we had a couple of failures just recently. What does Ira mean by that? Let me show you. If I can, I don't know if, no, I'm not going to be able to. I apologize. See, I'm moving that line. This was an outside day up. Then we came down, and now we just got over that day's high. The chart's a mess. Normally, when you do that, you go to a real important number, be it a key moving average or a Bollinger Band. Well, when these happen and you took that out, you were right on the moving averages. I'll show you what I mean. Here's your outside day up. But if you take it out, you're already basically right on top of these two averages and the Bollinger Band. There's nowhere for the market to go on the downside. So it's not that the outside day course didn't have an area to go. When you're right on top of everything, there's nowhere for it to go. So the market is caught here in an area where it's fighting for its life. And the question is it going to start the embedding process where both of the numbers in the slow stochastic get under 20 and stay there? And once they do that for several days or more, you change the complexion of a market. It'll get very bearish. So you're down to the area where it's more likely you're going to get short covering. You're into key moving averages. You're into the Bollinger Band and you're oversold. The conversion happens if we get a bunch of bad news in some manner and the market puts that down there. So am I looking for a bounce? I am. Would I be a buyer for that? Absolutely not. The trend is clearly to the downside. A bounce is a bounce, not a change in the trend of the market. All of the stock indices are in bear trends, and all of them have patterns like we're talking. They had the outside day up, you took it out, you went right to the Bollinger Band. I mean, it's exactly what I teach in the course. Normally, they're not on top of each other. You get a lot of width in the market, or you're underneath everything when it happens, and you get what's called a vertical price decline. That's not what you've got here. You're, again, oversold right in key areas of support. In the Dow, we did the same. Now, we did break down and didn't quite get to the 200-day. We got pretty darn close, and now we're coming back for those highs. Still a very bearish situation, and same in the Russell. Look at how this one's doing it. Again, you had the outside day up, you took it out, and you were right onto the Bollinger Band. So I'm very comfortable that what I teach worked, but there was no play to be had off of it, and it's why I want to keep the stock indices as our focus for the moment. In the T-bond market, lower highs, lower lows, you can see that. In the 10-year note, same thing, heading just down here. And look, you've had a bearish crossover, and when that happens, I pointed this out to you last week, when that happens, you normally try to make lower lows. That's what's happening. But you have embedded reading. That embedded reading means that the rallies in this market will continue to get sold until the red line closes over 21, and that could take a long time. I've seen it go a very long time. I've seen it get an end a day after it occurs. But right now, the market is saying, you know, we got a lot of new data for the month about to come out. We're coming to the end of a month, and how's that data going to look? All right, if it's strong in any manner, there's a problem. You're telling the Fed, hey, let's go ahead. We're 3 weeks away from the FOMC meeting as well. And in the dollar, I mean, you have the embedded reading. I am totally convinced the pros took half profit in the market, right up here against the Bollinger Band. They're sitting. If you get a reading under 79, I say they'll dump their dollars. Now, you'll say, Ira, you're telling me interest rates are going up. Isn't that bullish dollars? Yes and no. Yes, in a cycle where the market can absorb it and you're not killing the economy. No, where you take interest rates so high and you tip the economy over. Then what do you want to own that economy for? I don't care what they tell you. That's what this market is fighting. You have those two different parts of the road that it's on. The euro saying, hey, look at me. Don't forget me. I got a 21 reading. We were embedded. And if it stays lost, I think you're going back to the right up here, that red line, wherever it comes in, the 18-day average in price. You're losing it. This is starting to say and scream, be careful about being short anymore. For my money, be very careful. You could be up back to the 107 level. That number will fall a bit. You do understand it's an 18-day average. So unless prices immediately ran to it, which could happen, but generally, you get chart action that isn't that way. Each bar is going to be a day or so. That number is going to fall each day a little bit there. In the British pound, come on, let's give one thing. The Northern Ireland deal looks like it's got resolution to it. Now, what that's going to do for the new prime minister, I don't know, because there's parts of his party that didn't want this to happen. There's other parts that did. To me, it's a win, because now you don't have that roadblock to bring in medicines, foods, pets. I can go on and on. Life gets back to normal in a big, major way. And I think it's a win, and the market thinks it's a win. That's why you're getting the rally in the pound. But you're in a resistance zone that is oversold. Nah, I think the pros were covering, and I said it to you last week, all week, and I began saying it here. First challenges of a 200-day average. The first time you get down to it and you haven't been there in a long time, pros like to take money off the table to see what the market's going to do. Are you watching, for example, Bloomberg? All they're talking about is the 200-day average in the stock indices. In Bitcoin, you're back to neutral territory at the 18-day average of closes. Now, April Brent is bye-bye, gone tomorrow. So you want to have major move now to the May. So I've got on the May Brent versus the May WTI. The biggest difference that we've recently had is 677. We're still pretty good at 611. Don't get me wrong. There's a big differential here. You can see how the market keeps rallying to the 18-day average. It's a bear market. The bias is down. The trend is down. The pros are selling the market here. Stops over the most recent high, hoping to get back down to levels like that. In the April crude, shucks, I had orders in today for my clients and we didn't get a fill. We missed it by 20 points. That's not a lot in these markets. And then I watched the market come down. Still looks to me bearish, no change. Are we going to get back down here? Could be. This market is fighting what? High interest rates around the world, which are slowing economies down. So the first school of thought is, how much do they slow down? Does it hurt demand? At the other side, there's a Jekyll and Hyde to this. Hey, supply's not that big. As much as they're slowing down, China's coming out. China said today that they will consume 30% more jet fuel this year than last year. 30%. Well, what's that going to do for the demand for energies? Those are the things you got to think about as these markets want to play themselves out. And that's how I look at it. Gasoline, doing just what I wanted. The report that I did a while back, I said, I don't think you're going back here again. It's too soon to be long. We're not in the spring driving season, but we're also coming to the end, I think, where low prices are going to be the norm in the market. And in nat gas, obviously, you got oversold, you're getting a bounce, but I think it'll be contained in the upper and lower Bollinger Bands and that just drift around. There's no bull story yet for this market. It's a supply story, but it was such a monstrous decline. You're waiting for the event where you get some profit taking and short covering in the process, and you're in it right now. So again, I hope to see you all at the live webinar. That'll be Thursday, 12:30 p.m. Central Time. We do not post a recording of it on the website, so either attend or you miss it. Move your cursor up here. That's be an icon. Give it a click and register. I'm Ira. Take care.